how to calculate the correlation coefficient of two different stock prices in Excel. Let's get straight into it. Let's get my big head out of the way there. All right, so the correlation coefficient, just a quick summary. We're looking to see if there's a correlation, or let's just put it this way, a connection between two stock prices, two different stocks, all right? Why do we want to do this? So imagine if every time, I'm going to just pick two random stocks, every time Tesla goes up 10%, Coca-Cola goes up 5%. Every time Tesla goes up 5%, Coca-Cola goes up 2.5%. They're not having the same absolute move, but they are moving in perfect correlation. There's like a ratio and they're connected in a way, and that would be a perfect correlation in that example. Why this is relevant for anyone who wants to trade stocks or do sort of quantitative style trading is because if you can find a relationship that's reasonably strong, we'll talk about what is and isn't reasonably strong soon, you can sort of set like a band and a parameter of these two stocks that you found are correlated, and you can imagine as they move up and down in this sort of like the intertwine, for example. Now, if they separate from that band, you know it's quite likely that they're going to come back, that those prices will diverge back. So you can set up trades this way. The most common trade, the most common correlation trade is, let me just pick an example I know some people do, is say between gold and silver. They're quite correlated, they kind of move up together, but silver usually makes bigger moves than gold, so silver might go up, have a 10% day while gold has a 5% day. So that's quite correlated. And what they do, if they notice that, if assuming arbitrarily the correlation for gold and silver, let's just assume it's 1, which is a perfect correlation. Let's assume gold then has a day where, silver has a day where it goes up 10%. Now the correlation tells you it's a perfect correlation, and you work out the correlation ratio, and you know gold should go up 5%, but it doesn't, it only goes up 2. Then you can set up a trade because you know there's a strong correlation, so you know it's just lag and it should go up that extra percent to diverge back into where the correlation should be. Hopefully that makes sense, but look, let's do it. And we're going to get, after all this calculation, it's going to give us a number. And on the screen here, we've got an R of approximately 1, and that's a strong positive linear relationship. So that basically means that the stocks are moving in tandem. If one's going up 10%, the other one's moving 5%. If it's going down 10%, the other one's going down 5%, or so on and so forth. It's a perfect linear relationship, strong linear relationship. Now, another thing is a correlation of -1 is a strong negative linear relationship. Now, what that means is like an opposite correlation. Pick a stock, one stock goes up 10%, the other one goes down 10%. The latter goes down 10% and the first one goes up 10%. It's the opposite direction, and you can make trades off this too. This is great as well. So ideally, what we're trying to find is a correlation coefficient, which is just a value of as close as we can get to 1 or as close as we can get to -1. Both are tradable. If we start getting close to 0, it's not tradable. There's no linear relationship. You can't really make sense, meaning the movements are just kind of random between the two pairs of stocks. Now, you're never really going to get something really close to 1 unless it's like a real obvious one, like there's a gold indice and then there's another gold indice or something like that. But there's no real opportunity for trade there. Usually what I found, if they're too strong, there's no opportunities. The market's priced in too efficiently. So you're kind of left with, in a ballpark figure, between a 0.5 to like a 0.8 is a nice sort of range. There's tradable proper options there. Just remember in trading, if something's too perfect, if you know, we try to do all these calculations, and if something's too good, there's usually no room for profit. Profit comes at risk, and that's what it is. So we kind of want to aim for a correlation coefficient value of 0.7, around that range. I mean, it's not an arbitrary value, and there's no written in stone what it must be. But I would say if you start getting above 0.5, you can investigate to see if there may be a trade there, or at least keep an eye on it. So let's have a look. I'm going to pick two stocks. I've got a good little example for you today. I don't know the correlation behind this one, but I've literally just had a look on, just to give a good example. What am I doing? I've actually looked to see, I just checked on ChatGPT, what's a good correlation coefficient to check that might surprise our viewers. And I don't even know this one, so we're going to have a look. It's going to surprise me too. Supposedly there might be a correlation between McDonald's and Coca-Cola. So let's have a look. And another thing I did get is there's a surprisingly low correlation, so close to 0, between Tesla and Bitcoin. Maybe we'll do that another way. Let's do McDonald's and Coke. Because, well, when you think about it, they're both consumer products and they're both food and beverages. Anyway, let's leave my thoughts here. And let's get into this. This might be a little bit lengthy, but let's see if we can power through. Okay, so down here, R is the variable for correlation coefficient. So when you see an R in finance or quantitative finance, it usually means the correlation, or it's called the Pearson's correlation. And this is the equation here. So in a nutshell, you're taking the data points, each data point, which is going to be the price moves, the daily price moves, and you're going to subtract it from the mean, then you're going to multiply that from the other data set and take each data point and subtract that from that mean, and then you're going to multiply those together and sum them, and you're going to put that over the square root, and you're going to do the same in the denominator, but you're going to take it to the second power for both variables, and it's the sum multiplied. It's lengthy. I've done quick background. I'm a first year, almost completed my first year at university as a statistician, and God, my words are mumbling today, as a double major in statistics and mathematics. And when I was doing my sort of more entry-level statistics modules, I had to calculate this by hand with not a massive data set, but it took forever and it takes so long. So today I'm just honestly going to use an Excel formula to do it. I was going to punch through and do it, not by hand, but like more mathematically by hand in Excel, like manually putting in each one of these, like multiplying this column by that column and doing this. Like I have in my previous videos with standard deviation, but look, you get it. And if you want me to do this by hand or step by step, just using maths cells in Excel, shoot me a comment and I'll do it. But I'm just going to use the correlation formula in Excel and I'll show you guys how to do it. All right, let's get into it. So we're going to we're going to check the correlation coefficient of McDonald's and Coca-Cola. So first of all, we need clean data. You know the drill, clean data. We usually get that from NASDAQ if it's listed on the NASDAQ, and should be. So MCD is the McDonald's ticker, isn't it? Yep. So let's get McDonald's first. We'll do a year. Time ranges, don't probably go less than a year. 1 year, 3 year, 5 years is probably okay. Let's just do a year. Look, when I show you guys how to do the correlation coefficient on Python, within 5 seconds I can test 1 month, 6 months, 1 year, 5 years, and every time frame. But doing it in Excel is in 90. So let's just go with a year and we'll go from there. So I'm going to download a year's worth of price action data on McDonald's. Let's get that up. And we also want to do, and it was Coca-Cola, wasn't it? Ticker for Coke. Is that CO or something? I've got it down here somewhere. Coke is KO. Alright, we're on. Another year of data here, Coke. Okay, so let's tidy this data a little bit and we'll get it all on a spreadsheet. So, oh god, I just going to tell you which historical data CVS. Well, this one's Coke. So if it's in the $60 to $70 range, we know we've got Coke. But there's about to get a mix up between the prices. So then this one must be McDonald's. Okay, so like we did with the data we got to calculate our mean and standard deviations, we don't need some of this stuff. So like we don't need the volume. Let's scrap that. High and low, that's like intraday high and low. That's not really relevant. Just need the open and close. I like this to be nice and clean, as you all know, and get everything tidy and sorted before we export it to our main sheet. Okay, now we've got to remember that this one here is McDonald's. I keep forgetting. It is McDonald's. I better put a name on it before I forget, honestly, otherwise I'm going to be so annoyed with myself. Alright, let's drop that. Drop that in there. Let's actually move it down. I want to get a name in there before I honestly forget. Take it for McDonald's, MCD. So this is my second time even doing this in Excel, so I might learn a thing or two as well. But I do roughly know how to do it, so it's alright. And then this one is KO is a ticker for Coke. Okay, I've got McDonald's, and let's bring up Coke. So we can... I downloaded Cokes. This one. Yep, looks about right. So volume can go. High-low can go. Tidy up a little bit. All right. What do you mean? Why isn't that going for me? Of course. Gotta do this the annoying way. Cleaning data is the boring part. These dates match, right? Yeah, they would do. This makes no sense why they wouldn't match. Just check, because I'm going to get rid of this first day column. Yeah. By date? I should leave a little break in there, to be honest, just so we don't get... Let's just leave that. Okay. Let's get everything looking the same. What are you doing, mate? Okay. Here's McDonald's, here's Coke. We got open close prices. Actually, let's bounce this over a little bit more because I'm going to need a little bit of space because I've got to calculate the price differences as well. Alright, so we need price difference change, I guess. So this is just the daily... So this one is just going to go as the daily price difference. So we're basically just looking here for, is the price going up, down each day and by how much? Because we're going to need to plug those rows. That's the row we're going to take the correlation coefficient, because you take the correlation coefficient a few different things, but we just want to do it to see if the prices are related, see if the price changes are related. More specifically, the percentage changes. So we want the percentage change between the open and closed price. So it's going to be the closed price from the previous day No, well, the daily change is just going to be what it opened that morning, and the difference is going to be what it closed in that afternoon, isn't it? Maybe not, actually. Yeah, so no, we have to go to the close for the previous day, and why that is because obviously some prices jump. Because if there was no price jump or gap, you would see a 305.44 in this next day's open, but you don't. So the actual price change is going to be from the close of the previous day, to the close of that day. So it's just going to be close minus close in, isn't it? All right, well, let's just look. And we're done. We're going to validate this anyway, so it doesn't really matter. See what we get, eh? Open there, close there, open there. So then it didn't really... Why don't you divide by the open, and would a percentage be wise in this situation? Right, let's validate this. So what we'll do just to validate things a little bit is show the trading view. What one was I on? McDonald's? And we'll just check to see what day. So this day here, if we look at the top there, we got a 0.08. That seems to check out. Don't need that anymore. Oh, fuck's sake. Negative 0.08. So that checks out. Then we got a negative 0.51%. Let's have a look, eh? That's positive 0.51. What's going on here? All right, McDonald's. And why is it red? Negative 0.51. It's like inversed. I've done something wrong, haven't I? It's like the same percentage, but I've obviously done something wrong here. Yeah, it's inverse. I've just got the wrong formula. What am I dividing it by? I've just got the things backwards. It's that minus that. Yeah. I should do this at the beginning of the day, where my brain is fresh. Full day of studying maths, and your brain is just absolutely wrecked by the end of it. Okay, so yesterday it was up 0.0%, and then it was down 0.51%, and it was up 0.3%, and then it was up 1.09%. That's... I take a lot of time making sure the data is correct, especially at the start of long calculations, especially when you're doing things like stats. Because if you make a little mistake here, you screw up like half an hour's worth of work. And let's do the price difference over here. So today's close minus yesterday's close over yesterday's close. Let's make that a percentage. 2 decimal places. 0.41. Okay, let's check a few values on Coca-Cola. Right. Coke, up 0.41, yep. Down 1.49, yep. Up, okay, we're good. All right, moving along, we have the price difference here, which is what we're after. Now, that's the hard part. Done, validating our data, making sure our data is correct and precise. Now for the calculator. All right, so let's move on to the correlation coefficient. So we'll set up a little, call it R. So R value. I've only done this the longest way possible, not with the formula. So let's see what we get. So we want to do the correlation. So returns the correlation coefficient between two data sets. And as we can see here, that's correlation. Array 1 is going to be the data set 1 and array 2. Now, one thing I should quickly cover is the correlation coefficient is unitless, meaning like you're probably wondering like, will the percentage symbol here throw it off a bit because should it just be a value, not a percentage? It shouldn't matter because the calculation is unitless. It's just looking for a correlation. It doesn't really matter if that's centimeters, miles, kilometers, percentage, whatever. Well, so it says. So let's have a look. So this is going to be the first array, and this is the McDonald's price change, daily price change. It's array 1. And then we should comma, and then we want array 2. Yeah. I'm actually excited because this is something that I have no idea if it's correlated or not, or what it is. Okay. All right. Not as correlated as I was led on to believe. So we've got a correlation coefficient of. Let me make that bigger so we can see it nice and bold. We've got a correlation coefficient of 0.38. I mean, there's some correlation there, but not much. not much to try and make a trade around, to be honest. And I kind of thought it would be more correlated because they're both consumer type products. Like both stocks is food and beverages, the nuts and bolts of it. The way I like to think about if things are correlated is kind of think about what happens in a recession. Well, with these two products, I mean, Coke is everywhere. Third world countries, it still sells on. I mean, it would go down, and McDonald's is pretty cheap. I don't know. I just felt like they would have been more correlated. So that's your correlated coefficient done. And to find tradable things, you've got to test hundreds of different correlations and come up with heaps of ideas. So if you think of an idea of two stocks and you think, I swear they're going to be correlated, this makes sense. Bang in some statistics, work out a correlation coefficient, see if they are. Because some people say things like ChatGPT told me this was correlated. No, it's not. You're wrong. That correlation is pretty weak. So yeah, we want to prove it. Next video, I'm going to do this in Python. I've got a really good code I've set up. It's just a basic, simple correlation coefficient code, and it's not that many lines either. So I'm going to whiz through that, show you how it works, and I've got it set up so I can just change the value, the variables of the timeframes I want. You can even change the tickers, like imagine a candlestick. You can go 1 minute bars, 2 minute bars, whatever. This here is technically a daily bar. And you can really mess around and figure out. There's some interesting things that do appear and different date ranges, a year, 3 years, and things like that. And you can, within a click of a button, I mean, you can check correlations between heaps of different stocks. And we'll go through that, and I'll show some interesting correlations that I've found. And if you want me, I'll share the spreadsheet if you want the spreadsheet, and I'll share the code as well once we get to the Python piece. Now, before we go, I want to graph this correlation so we can see it visually and you can see what I'm talking about. All right, let's graph this correlation. Okay, so what we want to do is highlight both our data points, the differences like this. So we're going to plot one on the y-axis and one on the x-axis. I should say it the other way around. One on the x-axis, one on the y-axis. So we just want to make sure everything aligns in perfectly here. We don't need the date ranges necessarily for this one. Okay, now we want to insert. I want a scatter plot for this one, and we're looking for this one here. It's going to look confusing at first, but let me show you why. So let me just chuck a couple of really quick labels. 0 point. Just so we. I'll just write. We know R means correlation, all right? And let's enlarge this, get it nice and big. Let's label some axis title. We want that. Let's get a trend line going. Forecast. Just a nice simple linear one. Alright, so the y-axis is, I'm going to say, well, it depends what data I selected first, doesn't it? So maybe I should have a look at that first. Select data, edit. So the x is McDonald's. So the x-axis is McDonald's, the y-axis is Coke. Okay. Label these before we get confused. Okay, so what's going on here is we've just graphed our correlation coefficient. And you're seeing the same thing I'm seeing, so you're seeing it's all kind of bunched up. And this shows why it's not a good correlation. So on the x-axis is the daily returns of McDonald's share price. On the y-axis is the daily returns of the Coca-Cola share price. And if we hover over a dot, see this one down here. So on the x-axis, which we said was McDonald's, on this day, McDonald's returned a negative 5.12% return. Coca-Cola returned a negative 2.07% return. On this day, McDonald's returned a negative 2.12% and Coke returned a 0.29%. So if you were to see a perfect correlation, so we've got the regression line in here, everything would be sort of squished, really holding tightly, like quite close to that line. But you're not, it's like someone's thrown some paintballs at a wall and it's like splattered all over the place. Visually, that means it's not a great correlation, but you can see there's still some, and the reason why you can see is this regression line here is sloped. If the regression line was flat, it means there's absolutely no correlation at all. We have a small slope, so there's small correlations, but definitely not enough to kind of make some viable trades. And just to show you like how all over the place it is, we can just pick some arbitrary points on here. McD's dropped 1.31%, whereas McDonald's went up 1.56%. That's an inverse correlation, that specific point. One's gone down, the other's gone up. So this is why it's not really correlated at all. This one's pretty bad too. If you look at this, McDonald's only went up 0.58% and Coca rocketed up by 4.73%. So you can't really base much trades out of that. And this is the opposite. So on this one, McDonald's jumped 4.8% and Coke only went up 1%. So we don't really have too much good points. Now, at the ones where we go really close to this regression line, you can see like a kind of a closer correlation, I guess. But again, this is 2%, 0.72%. you'll see they're closer. They're not like, the distance between the two percentages isn't like way off as you get closer to this line. Yeah, but then as you get far away from the line, I mean, it's ridiculous. So there's obviously going to be some outliers, and sometimes these outliers can throw off your correlation, so you can kind of ignore some data points, but there's too many that's kind of all over the place here. Final conclusion, McDonald's and Coca-Cola have a really average subpar correlation. It's less than 0.5, not much to really base a trade off here. I wouldn't bother trading it. You could dig deep into some further analysis, mess around with some different date ranges, try over the 5 years. Maybe this year's just been a bad year for correlation between Coke and McDonald's, and that correlation is going to come back together, it's going to converge. Who knows, you could probably analyze a bit more, but conclusion, correlation in Excel was done. Next video, let's move on to testing out several different correlations really quickly in Python and try find a good relationship. And one thing I really want to do on this channel is I want to start to actually trade and set up some trades. I'll probably do the trading where you guys can see just on a do it on Interactive Brokers. I'll screen record opening and closing some option positions, a thought process and things like that. And but we'll do that at the end of all this thing. And what I want to do together is actually find a valuable trade, and we'll trade that together. Not together, but together as if we'll come up with the conclusions together. We'll do the quant research, and we'll place the trade just in a paper account on Interactive Brokers. But so you can see exactly where I place, why we're doing the trade, how I'm setting it up, the expiration dates for the options, is it puts, calls, buying, selling, what sort of combination. Monitoring that trade. I want to get a start to finish kind of amateur quantitative trade where we're doing this kind of analysis and see what happens, and we'll pick an amount, maybe a $10,000 trade on a paper account, of course, and we'll give updates and see how it goes. And if we find something, we then want to do something in statistics we call like a hypothesis test. Not a proper one. Well, you probably could still do it, but if we find something good, we then don't jump to it and put our real money in it. Let's say if we find a good correlation and a good trade setup. Good thing about paper accounts is we could set up that trade, say 10, 20 times on different stocks and hammer it out and sit back and look at our returns. And then we can do some hypothesis testing on our returns and statistical analysis and see if it is something viable, or if we've got to throw that in the bin and start again, which usually happens. Anyway, that's the end of that video. Thank you very much for watching.